So Sherman, why don't you tell us a little bit about yourself, how you got into venture capital, why you're in venture capital, and what your experience has been?
Yeah, absolutely. Well, I enjoy doing what I do, certainly, because I've been doing it for 25 plus years now. Grayhawk was actually founded about 20 years ago. And before that, I had a predecessor fund called Cornerstone. Started my career has always been in the finance world. Started with Bank One. Coming out of grad school, I was in their Dallas office, went through the credit training program, and was a commercial lender for short amount of time before jumping over to a group that was called Bank One Capital Corporation. And in that division, we had the investment banking group, capital markets, structured finance, and then multiple fund managers. I ended up joining one of those groups that managed a couple of funds. One was a legacy portfolio of equity investments, and the other that was more active was a mezzanine fund. You know, this is in the late 80s. So, it's a time when LBOs were very hot, and that was kind of primary activity for us. In 95, one of the investment officers I worked for at Bank One, he asked me to join him in helping to manage what became Cornerstone. And it was a small pool of capital from a nonprofit foundation based here in Phoenix, Arizona. So that's what brought me out to Arizona in 95. I've been living there ever since. And that fund initially was focused more on private equity. Starting out, we were backing fundless sponsors, but the market got pretty heated. Probably not as heated as it is today, but it caused us to kind of go onto the sidelines and revisit our investment strategy. And we ended up making some fundamental changes, but the short story is we evolved into more venture capital halfway through Cornerstone. And we've been doing venture capital ever since. So we went on to launch Grayhawk Fund 1 in 99, and that was our first true venture fund. And we've been doing that ever since. We're now on Fund 3. We're about to close out fundraising here in a couple months. We expect it to be about 75, 80 million under management. And our strategy will be a continuation, certainly, of Fund 2, which is really investing in early and growth stage software companies. So typically, you might think of it as Series A, Series B rounds. You know, if it's in terms of revenues, these companies should be about 2 million ARR or more at that stage. And our first check is 2.5 million. With kind of 1 to 1.5x that in, for in reserve for supporting the portfolio companies. And we're building a portfolio of 15, 16 companies like we've done with previous funds in this fund. Geographically, we like these underserved markets outside of Silicon Valley. So, SoCal is definitely part of our market. Utah, Colorado, Arizona, of course, New Mexico, across to Texas. Generally as far east as we usually go, but and we tend to lead about 2/3 of our deals. But we do like to work in syndicate groups where we bring on co-investors we're very comfortable with. So I have two other partners, Brian Burns and Brian Smith, who are both managing partners, and we brought on a new partner recently, Leigh Bolel, who's helping us with our Israel strategy. But that's the core of the team. And Brian Burns has been a partner for the last 21 years. Brian Smith came from 11 years. But we've actually co-invested together before through his previous funds. So we've known each other a long time. So it's a team that's kind of been together a good long time. And that's a team going forward with Fund 3 as well. Awesome. So that's I don't know if that may be more than you asked for, Len, but that's a little bit of background on Grayhawk and myself.
It's a good thumbnail sketch. You talked about SaaS or software as your primary focus area of investment. Are there particular portfolio companies you'd like to brag about in that space?
Yeah, so, we have in Fund 2, we like to brag about one particular investment, Lucid, a Utah-based company that has become a unicorn. They do shorting, I guess, to put it more simply, and they compete with like Microsoft Visio, if you guys remember that product. But this has a collaboration component. It's a SaaS model, and people just really enjoy working with it. So there's about 30 million users on it at any point in time. And then a few others. I mean, we have one in San Diego called Sochi. They do social media management. They're on great track. JMI came in recently as a new lead investor to take it to the next level. But we're very pleased with how Sochi is performing. We have a telehealth platform in Phoenix, Arizona called eVisit. And as you can imagine, through COVID-19, they actually really perform strongly as the need became greater for, telemedicine platforms. So those are some examples of our portfolio companies. We don't have a specific vertical. I say some recurring themes we like are fintech, cybersecurity, healthcare, IT. We've been doing more MarTech through the end of Fund 2 and into Fund 3. And not that we saw COVID-19 coming, but I think certainly post COVID-19, digital marketing will be a pretty good bet. But, otherwise we're generalists. The broad bucket would be your productivity analytics apps for enterprise.
Excellent. So you mentioned COVID-19, and here we are at 18 months coming out of it, or 15 months coming out of it. What has been the last 15 months for you as an investor? I would probably break it up into stages. If you look at a year ago, March, April, and May, and then moving forward from there, what did you need to do to adapt in your business?
Yeah, starting in the early stages there of COVID-19, it was very nerve-wracking. We sat down with every one of our portfolio companies to kind of reset expectations and prepare for the worst. I think most of our companies, we did ramp down revenue targets, but more importantly, really tighten up on the expense side. We found, in our portfolio overall, we weathered it pretty well. We're investing in software, right? It's not, it's not the same as those industries that are more brick and mortar, in terms of impact. Definitely much better insulated. And we don't have anything in real cyclical industries, that they cater to either. So overall, portfolio performed well. I can't think of any that went backwards. We had some that, hit a slow patch in growth, like Q2. But again, most of them came out with good momentum into Q3, Q4, Q1. So our portfolios performed well overall through COVID-19.
And as you've been raising your Fund 3, how has that been for you through COVID?
Well, actually, that we were impacted. This is, you might say, kind of the first time we went out on the institutional path. Historically, our funds, I didn't mention this earlier, and I don't want to necessarily get into nuances, but we've been an SBIC fund, which is a license you get through a process with the Small Business Administration that allows us to get matching dollars at very low cost. So we've been doing it with each and every one of our funds. It's worked very well for us. We're going to do it with Fund 3. But there is a little story of that. We weren't originally starting down that path with Fund 3. We were going down the institutional path, had a lot of good conversations towards the end of 19, beginning of 20. And then when COVID-19 hit, that almost came to a screeching halt, especially for new fund relationships. It was very difficult. But at the same time, I think COVID-19 kind of opened the door for us on the SBIC path again. The SBA has kind of veered away from, I guess with the exception of our funds, they've kind of veered away from VC for a long time, but their mission is to create job growth, right? And they recognize that jobs come from early stage companies, startup companies. And I think that kind of, opened the door for us to go down that path again. So we were green lighted for an SBIC license December, submitted our application like a few weeks ago, and expect kind of a license approval Q4 this year. So yeah, COVID-19 has definitely caused us to kind of zag a little bit, on the fundraising side.
How about on the investment side? Did you make investments in the past 12 months? And how did you meet those folks? Or did you initiate any new investment relationships in the past 12 months with people maybe you didn't know?
Yeah, I think COVID-19, presents, some interesting opportunities, certainly shifted focus towards, certain type of opportunities. Again, MarTech, I think, will be a good area. Supply chain, some of these things that COVID-19 directly affected that we might not have paid as much attention to without it. But so I think there'll be good opportunity, there'll be interesting opportunities post-COVID-19. We have made a couple investments out of the new fund, both generally in the MarTech space. One's more of a data place, a data management platform, but it's geared towards marketing departments of large enterprises. Company is based out of Utah. And the other one is a Bay Area company called Follows that has a platform built around account-based marketing. So they allow enterprise to personalize campaigns at scale. And they're performing quite well. That was our first investment in Fund 3. We continue to have good relationships with a number of VCs out there that we like to co-invest with. And so nothing's changed in that regard. I think it's been a good environment. I think a lot of VCs I know are performing quite well in their portfolios. So those are some of the areas that we're kind of moving towards.
And as you look at, as we come out of COVID-19, are there things that you learned operationally on how you engage that you would like to bring forward, or do you think it's going to go back to what it was like in February of 2020?
No, I think certainly with our existing portfolio companies, I think there were, some good lessons learned. One of our companies, really tightened up on expenses and really ended up not missing a beat on the top line. So they learned they could really do more with less, So sometimes you need a good kind of little crisis, to kind of take a harder look at your business and operations and such.
I think that's true for probably everybody on the call. I think we all are coming out of this with lessons learned, and hopefully we'll improve our operations and our ability to communicate in a timely manner. And while I missed the one-on-one, person-to-person meeting, certainly this format has proven itself to be beyond what I expected it to be. And I think just in the couple of engagements that we've had over the past year and being able to reconnect, it's a heck of a lot easier than you having to come to Los Angeles or me having to go to Phoenix. So, that makes it easier.
Well, I kind of miss that though, especially during the summertime.
Yeah. Yeah, I'm sure Santa Barbara right now is 40 degrees cooler than it is in Phoenix. So
yeah, so I'm glad things are opening up here. But I think, so far we've not had to make any investments so far without some kind of in-person interaction with the management team. I think that's still important to us. But yeah, like you said, a lot of these meetings can be done, via Zoom.
How about conferences? I think a lot of us have, used conferences as a way to network. Where do you see the future of that going? And do you miss them, or were they just kind of the things you had to go to and worried about, how long am I going to be away or whatever?
I haven't been to one in a while, and I haven't really done done too many virtual conferences. I think the networking part is a little tougher. Although there are better technologies coming out to allow folks to do that, you know, do these little breakouts and such, or actually see somebody walking to your table, you know. I've not actually tried that yet. So I kind of miss the conferences myself personally.
Yeah. How do, you know, someone is interested in talking to you at Grayhawk, what do you prefer is the best way for someone to engage and introduce themselves to you?
Well, I think the best way is really through a warm intro, right? You know, maybe it comes through you, Len, if it's someone you know. But we usually like to have some kind of warm intro versus a cold call.
Yeah.
But yeah, but we are fairly accessible.
And do you find that the deal flow that you're investing in is companies that are coming to you through those warm intros, or are you seeking companies out specifically and looking for those opportunities based on performance and what you're hearing through your colleagues in the VC space?
Yeah, most of it comes through intros, actually.
Okay, good. That's good to know for all of us here on the call. You've talked about syndicating. Are there funds here locally that you like to syndicate with?
Let's see. Excuse me. Ones I've syndicated with, you might know Brian Messick at Ancona. Mm-hmm. With an LA fund, Anthem. Now he's relocated to San Diego, of course, and launched Ancona. But he's a great guy. Someone I enjoy working with in the past, and it wasn't an easy situation either. But we've and then subsequently we've co-invested again in another company. So that's an example of a Southern Cal firm. Some of the others we see deals from are like Bonfire, Embark VC, which used to be, you know, Baroda, mm-hmm. and the like. But, you know, there aren't too many. I mean, there are a lot actually in LA. I can't say I know the LA groups real well. The Grayhawks, you know, are probably too big. You know, they could usually do a whole round themselves. So we like working with kind of like-size funds. But there's a number of the Bay Area we've worked with before, Benamo Global Ventures, Vertical Ventures. They actually come down to SoCal quite a bit. Canvas Partners are some examples, and then a lot of the regional groups too, like Boulder Ventures in Colorado, Epic Ventures out of Utah, you know, Signal Peak, some of those folks. Excellent. Sampling, yeah.
Excellent. Well, let's talk about where you would like to see the venture industry go from a macro standpoint, and where you see it today. And is this something that you know, we're going to continue on this trend of more money available? Because I think 2020 was a record year in the amount of money that's been raised and available in venture capital.
Yeah, you know, I think there's certainly going to be plenty of opportunity, and I don't see the industry shrinking per se, maybe in the number of participants, but, you know, software as a category, being kind of the, you know, the largest category that VCs invest in. Certainly there are others like, you know, the life sciences, robotics and such, but in any of those areas, I think really they'll continue to expand and proliferate. All right, so venture plays a vital role, you know, in their life cycles, and so I think venture capital will continue to grow. Now, you know, with the mix, you know, the mix is shifting, has been shifting over the years towards these larger institutions, and I guess selfishly, I certainly would like to see, you know, more institutional capital coming into some of these smaller funds as well, you know, and supporting smaller funds. But generally, you know, I think the industry will stay robust.
What's the startup environment like in Phoenix?
You know, it's been fairly active. A lot of incubators, accelerators that have popped up over the last 7-8 years. So we're seeing a lot of early stage activity at this point. And then, we'll see kind of what bubbles the surface, but it has been active.
And how about local capital other than yourselves?
Not much in Arizona.
Yeah.
I mean, we have a few the organized angel groups, like ATI and Desert Angels and such. But kind of the Series A folks, there's us, there's Social Leverage. That's a kind of a true committed fund. And then beyond that, I think you have maybe some family offices, making these kind of investments. So it's pretty light. Back in the heyday, there probably were 5 or 6 of them, major funds here. So it's kind of thinned out a bit. It would be good to see some more funds come into Arizona.
Going back to, as you look at opportunities to invest in, what are some of the criteria that are important to you in order to make a good decision on an investment?
Yeah, so the 3 kind of broad areas we look at, and each will have kind of subcategories. But the 3 broad areas are going to be the product, right? Strength of the product, uniqueness, defensibility. The market, size. We're looking for $1 billion plus, opportunities. At least a few years out, and management, right? And within market, for example, we'll look at competitive landscape, of course, those sort of things. So there's probably 6 or 7 kind of key vectors we look at. Transaction structure as being one of them. It has to be at the right price and structure. Syndicates become actually important criteria for us. We want to work with a high quality syndicate. And I mentioned earlier, from a financial standpoint, we want to see AR of 2 million. So these are companies early enough where we get reasonable ownership, but far along enough where we could be able to analyze even some financial metrics, over the 2 or 3 years that, since they launched. And then, beyond top line, growth obviously is important. And then we'll look at churn and such. And that's why we like enterprise software, and as opposed to SMB. Kind of a general comment, but churn is something that could really defeat, SaaS pretty quickly. So you generally have higher churn associated with SMB markets. So those are kind of some of the key things we look at.
Excellent. Any red flags without disclosing a company name that would something to watch out for, or something that you have noticed in companies that have come to you for capital?
We always learn something on every deal, and usually if something doesn't work out, it's something we miss. It's not something we thought was a risk, But we have caught things. There was one deal that looked really good on the surface, but the company, in its first batch of due diligence information, gave us their bank statements, like 3 years of monthly bank statements, which is a little odd because that's really getting into the weeds a bit, and probably more towards the end of our due diligence request. But we found an anomaly in the bank statement, where it was actually altered and didn't reconcile with their actual cash balances on their financial statements. So
that's a red flag.
That's a red flag, right?
Well, poor accounting.
Yeah. So that went away pretty quickly when we started asking questions about it. But you catch those things, some things like that. We've had situations where the references on the founder or CEO wasn't real strong, and actually it was a reference that the person gave us. But we do like doing blind reference calls as well. So those are important. Talking with customers are very important, but I can't think of a situation where the reference in that regard has come back really negative. Yeah. Well, anyways, those are some examples.
Okay, those are great examples. Are there, as you look at deals, then you said what your criteria are, but for you personally, what connects with you? What do you like as far as when you're looking at a company, whether it's the product or the team? What is the best connection that you can get?
Well, I think the thing about our business is important not to get too honed in on any one thing. I guess one of the things I would say about our team, we come from pretty conservative backgrounds. We come from the finance world. We don't fall in love with the product. We don't necessarily fall in love with the team. We feel like we can coach, I mean, that could be a negative at times too. We don't really have operating backgrounds per se, but we do bring in resources when we need them. Right. So we the important thing is to be objective around all the aspects of a deal. You got to really, look at the market again, those three big categories: market, product, and people.
And then as a company looks at Grayhawk, other than the money, what value add do you think you can bring to the table for a company that would make it attractive for them?
Yeah, I mean, we feel like we could point to our, success in our funds as examples of way we've guided companies to good outcomes. We could talk about the various resources, Rolodexes, like most other funds would. But, at the end of the day, I think the chemistry is important, and being able to keep a cool head through difficult situations. And so we feel like we're each of the partners are pretty even keeled that way.
Super.
Management teams.
Well, I've gone through all the questions I had prepared for you. I'm wondering if there might be questions from our participants here. If anybody would like to ask a question, I think the best way to do that is unmute yourself and ask the question. I'll try and moderate that if more than one person's talking at a time. But does anybody have a question? And you can either use the raise your hand function. Marshall, why don't you go ahead and ask your question?
Sure. Hi, Sherman. Nice to meet you. Thank you for coming on today. So you're on Fund 3. You've been doing this for 20 plus years. Is there anything you've learned over that time that you wish you knew going into Fund 1, whether that's raising, whether that's investment wise?
Oh, so many things. For 20 years, we got plenty of scars, to show for it. Again, you learn almost something on every deal, but at a more macro level, if you look at Fund 1 versus Fund 3, certainly the verticals we focus on has shifted. Starting out in venture capital, we were a little more opportunistic. So if you look at Fund 1, half the portfolio was in software companies. The other half included like semiconductor, med device, gaming. I even touched upon life science, and so we've since kind of honed in. Not that we did bad necessarily in those other verticals, but there's just a lot as we kind of really studied it. Software just seems to be, and the way it's evolved has become, one, very capital efficient, allows founders to get to market faster. You have great margins, and of course, very strong multiples. So that's how we kind of honed in on software, so that's one significant change across our funds. The other thing we learned, I think partway through Fund 2 actually, is the importance of working with good syndicate partners. Part of it is frankly, the round sizes are getting bigger, over time. But we do like having extra eyes, extra resources around the table to support the portfolio companies, and the capacity, frankly, because it's the company will always need at least a couple of rounds of financing, right, to get to the promised land. So that capacity is important.
Super. Thanks, Marshall, for your question. Does anybody else have any questions? This is a great opportunity. Ramon.
Get take my video there. Hi there. Thanks for the time today. Quick question. what's your sense of the industry in terms of, in my particular company specifically, we have we sell technology and data service to the CBD and cannabis markets. And from an investor view, you know, a lot of investors will have LP agreements where they can't play in those spaces, but, you know, we're not an operator. We're basically selling technology and data to them. Have you seen an evolution? So my question is, have you seen an evolution in terms of how, how investors are able to play in those spaces and get the LP agreements to allow investment in technology, even if they're not investing in the actual thing itself?
Right, right. And, we've certainly seen some of those technology plays, I think, that are interesting. You know, for us, it's pretty cut and dry. We're an SBIC again, which is, which is part of a federal program. And we are in a regulated environment. And part of the regulations say that we can only invest in companies of, quote, public interest. So we are barred, frankly, as an SBIC from investing in any business that is in the weaponry industry or gaming, as in gambling, cannabis, etc. And that probably includes tech companies as well. If their primary market is, say, cannabis.
Mm-hmm. And would that include the hemp as well?
Oh. Yeah, probably wouldn't do it as well.
Hey, why would that be? I mean, it federally legal as of 2018.
It's legal. Well, a lot of these other industries I mentioned are legal as well, but we're barred. We're restricted from investing in those verticals.
Thank you.
Ramon, thank you for your question. Does anybody else have a question? I will not beg. But if you do, there's two people with questions. Hang on, let me see who they are. Adrian, why don't you go first?
Thanks so much for joining, Sherman. Can you hear me okay? I'm on Bluetooth.
Sure can.
Okay, I'm a partner with Stubbs Alderton, and I just wanted to ask you about when you mentioned defensibility and protectability as some criteria that you look at when you're evaluating companies. Can you tell me a little bit more about how that looks in the software industry and what you think are good measures that companies take in that regard?
Yeah, so that's not as cut and dry response. You know, software, I mean, we don't require, and you don't often see like patents, right, in the software world. Because there's a lot of kind of workarounds, frankly, and it's quite an expensive process. But we do try to understand, the coding and such. I won't say understand the coding, but understand the complexity of behind the solution. And we like to see companies with at least maybe, kind of a year or two head start, So that's kind of how we look at defensibility around the product. And again, we used to look for, specific IP around products and such, but in software world, we don't.
Thanks very much.
Adrian, thank you for your question. Are there any other questions or comments from the audience here?
Yeah, I'll go ahead. So thanks, Ernest and S8M for putting this together. And I definitely empathize with you being in Phoenix. I'm in Fort Worth. It's 110 degrees outside, so I empathize there. Basically, what do you see with inflationary concerns? Is that going to really affect you guys at DC level, or what's going on there with inflation?
It's, yeah, I mean, obviously, it certainly increases your expense structure. So that would be one impact to it. As an SBIC, right now we have access to very low cost capital because of the interest rate environment we're in. It's like the actual interest is like 1.7%, for half of our capital that we can deploy. I think certainly with rising interest rates, that'll impact us in that regard as well.
Thank you.
I've been moderating Jerome Powell's speech right now, and I believe he's talking about raising interest rates in 23. So, or at least that's what he's hinting at least. So, yeah. Thanks for your answer.
Yeah. Joseph, thanks for your question. Amy Wood had a question from Pepperdine. She runs the Most Fundable Companies competition. And Amy.
Hi, Sherman. Thanks for all the information today. And I was just curious to know if you had any advice for the founders here on the structure of the earlier rounds that they've raised. What makes them more or less attractive to you in terms of the follow-on rounds that, you know, either the A or the B that you're participating in. And there's a second part to that, which is, are you structuring any of your investments differently now than you were in prior with the prior funds?
So to answer the first part, I don't usually have any particular preference. I mean, other than keeping a clean cap table in general, right? But in terms of kind of a price round or a bridge round that came before us, you know, we could usually work with any of those type of structures. What was your second question again? Oh, how we structure our deals now? You know, I've been in the industry long enough to see some different cycles, and the market, you know, will shift to address certain trends, you know, with increasing valuations. You know, I could see potentially going back to, you know, having some kind of participation feature, which, you know, last few years, you haven't seen as much, but it's a good way to kind of bridge the gap, right, on the valuation discussion. That's probably the main thing. Yeah, I can't think of much else that would necessarily change there.
Any other questions? I do have a follow-on question since you mentioned the V word, valuation. In the past year, what have you seen with valuations? Has COVID affected valuation of companies, or have you just seen that upward trend continue?
In general, I'd say we've seen the upper trend. I mean, the growing valuation trend continuing. I think through COVID-19, you know, the companies that were impacted certainly probably got penalized for it. But those that kind of got through it probably didn't miss a beat in terms of valuations. And it's just continuing to go up. You know, so great. Harvesting our portfolio.
Very good. Thank you. Any further questions? Not seeing any. Sherman, as always, it's a pleasure to see you. Thank you for participating today. Do you have any closing comments or advice or words of wisdom you'd like to part with?
Oh, I don't know. I'd ask him to lean on any words of wisdom from me. But, yeah, but good questions today. Appreciate it. And I guess I would say to the entrepreneurs here, you know, don't give up on your passions. You know, it could be a tough road at times, fundraising and other challenges, you know, growing, launching a company, but keep after it.
Very good. Thank you, Sherman.